Oh, I just wanted to take a little time to talk with you a little bit about milestone one and the final project. There seems to be some confusion, and indeed, some of the things are not uh, clearly written or explained. But not to worry, we can handle those things. Um, if you look at the syllabus, let me show you this. I'm sharing the screen, so I hope you have yes. So here we have the discussion. The discussion is called the time value of money. Then we go to the final project critical elements, and we have something called the time value of money. Of course, it has several additional issues that have to be addressed for the final submission. And this is why they were talking about some of the Word documents and some of the explanations for your write-up. If you look at milestone one is far less in terms of requirements. So what we're looking at here are the five critical elements for the final project, which must be handled. Now, they're more or less one for one with the milestones, and it's supposed to be that way, except that you have, in this case, you have, less requirements for the various milestones. And one of the reasons it's not that somebody neglected or anything like that. It's we have a lot more to do in order for you to get to answer all of the questions that are in the final project. So when you talk about risk and so on, I had one student who was looking at the whole thing in terms of the critical elements, and it was getting to be very confusing for him because he was looking at the critical elements and I assume not what the milestone was saying. Now, if you look at these, you will see that you have the various milestones, and then you have the final project submission, final analysis report, and basically the final report is going to be sort of, or should be something of an analyst report where we talk about all of the issues with this company. We discuss the future of the company. We look at all of the macroeconomic elements, all of the industry elements, and so on. As you know, companies don't operate just in a vacuum. They operate within an industry, and within that industry, there is a sector, and the sector it operates within the macroeconomic environment. As I mentioned, we use a pest kind of analysis to look at the elements of the macroeconomic environment. And generally, Porter's five forces are used as part of the industry analysis. If you haven't done any of these things, you can look at the annual reports. You can look at the 10Ks, and they give you a lot of information about what the company is thinking, about what they think for the industry, and so on. There's lots of information available in the annual report and the 10K, and you just have to go and do the research and find that information so you can do some predictions. Alternatively, you can look at some industry reports. So how do you know? Well, you understand the sector, and you know the industry in which the company operates, Home Depot, and you can try to get online and find what the projections are for the industry. But generally, if you look at some analyst reports for Home Depot, and you can get some of these online for free. So if you go to like Yahoo or Reuters, I don't think they charge you for those. But I can get some for you, and from my trading platform, I can send them to you. So that's not a problem. All right. Well, you can read these things and you can find out what is projected for this industry and develop a bit of an intuition for the industry and the sector and how they're going to operate over the next 3 to 5 years. Generally, we can't go beyond that. Things are moving too quickly for us to understand what's going to happen beyond that. Even 3 years today, could be a long time for us. In any event, you can see from the workbook that all of the elements in the workbook in milestone 1 and milestone 2 and so on are not really fully addressed as required by the critical elements of the final project, okay? They're two different things. So we have one section that deals with the critical elements of the final project, and eventually we will get there because we have to cover a lot more things. We have to talk about risk and how we do valuation, which is coming up very quickly, of stocks and so on. Now, it gets a little. They make it a little bit simple for you in the milestone 1 by saying, okay, use these numbers on page 43. Alternatively, if you go to the 10K, let me see if I can bring that up. Okay, here's the 10K. The 10K has the income statements. So the income statements for a number of years will give you revenues and some cost of goods and some general expenses and so on. And it can get into very detailed income statement later on, or statements for the years. If you take a look at from 13 to 15, you can develop an idea of a trend. You can probably forecast some kind of a growth rate. And I'll talk a little bit more about growth rate as we talk about valuation. And you can maybe develop an idea of what's going to happen, or some intuition about what's going to happen in years 2016 and 2017. Now, you're fortunate in that we're in 2017 right now, so the release you probably already have. You can probably go on the website and get the 10K for 2016. And we're in earnings seasons now, so you have the first quarter, but don't worry too much about the first quarter. You can look at 2016, and you can see what that looks like. You can project a little bit. So they taught you how to do, or should have taught you how to do projections out of your accounting course. Well, here we have the cash flows for 2013, 14, and 15. If you imagine yourself sitting at 2013, you can look ahead, 2014, 2015, you can see what the cash flows are from operations. Now, normally, when we do the forecasting, we don't have all of this information available to us. And as I mentioned before, we normally take the 5-step process that we discussed in chapter 2, and we look at that 5, and some of those things we have to project. We're not going to be given all of the stuff. So you have to be able to do that. You have to be able to figure out what is required for net working capital and so on. And there's a process that you follow to figure out, and it shows you in chapter 2 what that process is. So you should be able to follow that, use the numbers, and come up with some reasonable net working capital and some of the other things that they're asking for. Don't get too upset about getting exact numbers, because we can't project the things exactly to the dollar or even to $100 or something like that. But generally, if our procedures are okay, if we follow a good process, generally we will fall in the ballpark of the valuation. And remember that, this is not an exact science, and nobody's going to look at exactly what the numbers are going to be and say you're right or wrong. We look for process. We look for the way you follow and the process and the way you do things. And that's more important than coming up with a specific number. How I grade, it's not just looking at the number and say, oh, you have the number, so you get 100%. I have to be able to see that you're following a good process, or a process that we talked about in the book, and that you're coming up with your numbers in a way that is predictable and that you can use in the future to predict values for companies or for stocks. So sitting at 2013, you can look at this and you can figure out what the trend is, and you can probably project a little bit about the cash flow for 2016, or you can go to the 2016 10K and look at their cash flow for 2016. And so then we would have 4 years of cash flows. If you're sitting at 2013, you can do the present value, discounting all of these at an 8%, and you can get the present value of the company. Now, having said that, that's not the whole picture. We discussed something called terminal value, and the workbook didn't give you terminal value or how to compute terminal value of operations or for a project or for a stock. And we're going to learn a little bit about terminal value for the stock coming up very shortly, coming up this week. So you must always think that the companies, because large corporations like Home Depot, they are ongoing operations, as you learn from accounting. So we can think that the operation will not stop at 2015 or 2016, but this company will continue to generate income off of its asset as far into the future as we can see, and we call that infinity for all intents and purposes. And so we have to figure out that if we understand what the cash flows are from 2013 to 2016, let's say, or 2015, that what happens beyond 2016 or 2015, let's use 2016. What happens beyond 2016 to infinity is called the terminal value. And there's a substantial value in that terminal value. So basically, we compute the terminal value, we add that to the projected values that we have here for the first 3 years, and we bring that back all to the present value, and that would be the value of the operation. And the same thing for stocks. So we will talk a little bit about that. Why do we do this kind of stuff? Why don't we have one number to predict out into infinity? Well, we have a formula that says the company can grow forever at this rate, and we can use a formula that shows the constant growth formula for stocks and for anything that is generating cash flows, and we can compute the value of that asset or that investment or for the company. But typically, you have investments and projects which will result in what we call abnormal growth in the near future. So if you take an example, if you take Apple and you take the iPhone, when they come out with a new model of the iPhone, that phone might generate very high revenues for the first year or two. These days, we can't really go beyond that. In the old days, we could go 4 or 5 years before we can see a normal growth. So basically, the asset or the investment will generate a normal growth that is above what is normal. And let me explain that. Suppose Home Depot is projected to have over time. And you can figure that out. You can look at some of the analyst reports, you can look at the 10K, and you can see, or you can do an average. You can take 5 years of revenues and you can do an average growth. You can say, how are they growing for the last 5 years? But if you look at the industry average and you look at this company's information, they will give you, they will say this company on the average has been growing at 5% over the long term, and over 30 years or 20 years, they'll give you like a smaller number, something 3 or 4%. So you want to look at these kinds of things, but you can figure that on the average over the long period, the company is not going to grow faster than the economy, except for shorter periods of investments. So over the long term, you know, Home Depot might be growing at some percentage, some 3-4%. I mean, the U.S. economy over the long term is growing probably 2 to 3%, if that much. But it's not that companies can't, on the average, grow higher than that, because there are periods of abnormal growths when they make investments. And so when you average those things out, you might get a number that is higher than the growth of the economy over the same period. But a company can't consistently, you know, unless they make new investments and so on, grow normally above what the economy is growing if they do absolutely nothing. If so, then they become the economy. But you can look at some of the data that has been collected for Home Depot, and you'll get an average, or you can compute an average. I don't care which one you do, as long as I see a process in place where you're following a good process to get some numbers that we can believe in. We can, you know, credible numbers. Okay, so you can project out growth, you can project out some cash flows, and you can even project out revenues. And if you look at the instructions that are given in the final project, they ask you for projection of valuation based on revenues, not cash flows. But normally, we don't value a company based on revenues. Accounting people might have some formulas and so on that you can use from an accounting side that will give you a valuation using accounting numbers. But finance people just don't use that. Because too many things can be manipulated and can be changed and so on. Finance people, they use cash flows and discounted cash flow analysis that are far more valuable and predict and result in reliable data that can be used for valuation, and it's far more acceptable to investors than revenue numbers. However, as we said, in Chapter 2, we talked about looking at revenues using the 5-step process and going from revenues to cash flows. Now, later on, we're going to have a capital budgeting project, and we will talk about this. Capital budgeting project will be starting a store, so that will be another project that will be used to find the valuation or to increase the valuation of the company. That is in addition to what the normal growth is. All right, so let's take it one step at a time. So right now, you're just doing milestone 1, not critical element 1. You're doing milestone 1. And milestone 1 has certain requirements, which we are going to be looking at. But you can start thinking about what's the additional requirements are for the critical elements that you're going to be submitting in a final project. So keep them separate, because This is what they gave you in the final project workbook. Okay, so we go along with that. But we can do some additional things, and I will send you, some more information on Home Depot, and you can look up these things and start becoming familiar with what is happening at Home Depot, so that you can be prepared for the final project. Now, even in the final workbook, I see some of the elements are left out, but as we get closer, we will talk a little bit more about what the final report might look like. Computations might be a little bit different, but the workbook doesn't show it. So even though they ask about it, so we might have to do some discussion and some examples and so on that you can show in an Excel spreadsheet. So as we get along there, we will talk a little bit more about that. But don't worry too much about a final project as yet, because that creates a lot of confusion. That's why we develop milestones. The milestones are there to kind of match what we're learning on a module by module basis. And then finally they come together. And when we hit the final project, we would have had all the pieces in place to kind of look at all of the elements. If you start just looking at milestone or critical element one for milestone one, we're going to be, some trouble. And I had one student who is already doing this, and it's creating some problems. And people get frustrated, and we start hearing complaints and so on. And it's no need really for. And if we follow the process and we do what is asked, and we read the book and we do it, it should be okay. It's not so confusing. All right. So let's take a look. So here we have the cash flows. If you want to try your hand at developing a value for Home Depot, which eventually this is the value of the operations. So value of operations will be, without any interest deduction, any interest payment. That's the free cash flow to the firm. When we deduct the interest, we get free cash flow to equity, and then we can figure out the value of the stock. Of course, there are other ways of figuring out the value of the stock. So, and we will cover all of them. So why don't we look at that now? So here is where you get the cash flow. If you look at some other things, you will see we have here we have stockholders' equity, and we're not going to use that. Here we have consolidated statement of earnings or income statement. You can see this one here is a kind of an abbreviated income statement. Generally, we have a lot more details. But you can see here net earnings. So you see the net earnings here. And then, or, some of you call this net profit, or something like that. And then you have diluted basic earnings per share and diluted earnings per share. And there's a difference if certain things are in place, and the accounting people will be able to tell you. In any case, if you study intermediate accounting, there's some set of criteria on how basic earnings and diluted earnings differ. All right, not to worry about that. We're not going to worry about that. We're doing a lot of cash flow. We're not doing the accounting, so we're doing the financial side of things. Okay, so this is where the income statement is. And of course, the balance sheet is before that, consolidated balance sheet. All right, so this is where really you find the information. I know they told you to use the information on page 43, but if you want to see where cash flow information is, here it is. You can only use cash flow from cash flows from operations Why? Because that's independent of any of raising capital and so on. It's just the pure number that is generated from the assets of the company. And this is how we do valuation. Now, later on, we will see that we include project-related finance as we go on into the next section, and the capital budgeting piece. We will see that we can use the cash flow, and I'll show you how that is the financing part, and I will show you how that is factored in to the into the valuation process. So, this is where we get cash flow. Now let me show you, of course, I think I mentioned already. So here, these are the critical elements. And the critical elements, these are the milestones. And the critical elements are not, let me see, not one for one exactly as the milestones. And you can see the milestones here, and then you can take a look at the critical elements, and you can see that they have a lot more factored into that. Here are the milestones, and here are the critical elements for the final project. So the two things are a little bit different. They have different requirements. Some of you are starting to try to look at time value. This time value of money here is exactly the same as milestone 1. And then you get very upset and confused and so on, because you're not looking at exactly what milestone 1 requires. And here's milestone 1. So take a look at those and just go along with the process, follow the process as we go along. Don't try to do the final project right now, because if you try and you don't have all the pieces, you're going to get frustrated and you're going to, think we're not giving you enough information, but just follow the process. Here is discussion, and this makes it a little bit more confusing also, because now you have a discussion with the time value of money, and they give you something totally different to do here. And so that's okay. Let's just not mix them all up and get confused. Let's take them one step at a time, work with them, and you will have the answer. Just don't think too far in advance. Let's cover them one step at a time, and we will get there. So right now, we're looking at the time value of money here as part of the discussion. That's one grading. Then you have the second grade for this project. This week will be milestone 1, which is also called the time value of money, to give you something else to do. And they use those numbers and they say, well, use that to figure out what the value of the company is. It's not hardly the number that can be used to value the company. As you see, Home Depot is quite a very valuable company. The cash flows is what you use, and even if you use the cash flows, it's not sufficient because terminal value is not included over some period of time. So you cannot neglect terminal value. As you will see, terminal value is a substantial part or percentage of the value of the company. Now, I think I started to talk about why we would use free cash flow in one period and then terminal value, not use one thing like a constant growth formula to figure out the value of the company. Basically, if we make an investment, we can have an abnormal period of growth that might go 2 or 3 or even 4 years, in advance. So Home Depot is, you can see Home Depot has been acquiring companies and making substantial investments in new lines of businesses and changing their strategy about how they do business. And it's paying off because you can see the stock price has been going up, given that, and given the fact that the housing market, the dynamics of the housing market has really changed, and you can really find the information about this going back to the financial crisis of 2006, 2007, and so on. They call it 2008, but 2008 is when the bubble burst and all hell broke loose. But that's not when it started. It actually started around 2004 and 5. And believe it or not, even people like Bernanke was involved in what we now call the subprime meltdown. In fact, initially they hailed it as an economic miracle as we were going forward, because the U.S. Economy is largely driven at first by the housing market. Housing market is the first leading indicator of what will happen in the economy. And it's a critical element. So when they started to see growth in the housing market, it was considered an economic miracle, given what happened with the accounting meltdown going back. The bubble burst, technology bubble burst in 2000, 2001 timeframe. Then we had the accounting scandal in 2004 around that time. So lots of different problems were happening with companies. And so when they came up with this idea of a new way of attacking the housing market and a prescription for growth in the housing market, which will indicate that the economy was growing, and big political decisions and so on. When they saw what was happening before the meltdown, before the bubble burst, all of the financial people were hailing this as an economic miracle, a financial miracle. And as I said, even Bernanke was the guy who said this was a great thing that was happening. And imagine that. So there could be abnormal growth for some period. And in this market, if you look at the housing market today, and I'm just going to give you some hints. One, it's growing. Two, money is still cheap. Mortgage money is relatively cheap. Three, there isn't enough of a stock of new inventory of homes to satisfy the demand. Put those together and see how can you predict the future of Home Depot stock? How can you predict, or can you predict, what will happen to Home Depot in the next 3 or 4 years, given these conditions at this time? And I leave that to you. I'm not going to give away the answer. You can think about it, you can figure it out. You have to do some work. So let's focus on the discussion and milestone 1 at this point as they give it to you. And let's just take it one step at a time, milestone after milestone. And, the PowerPoints and the chapters that are required reading for the module must be completed. You must do that, or else you're not going to be able to understand what's going on. If you try just to do the project without the reading, it ain't going to happen. We're going to get a lot of emails and confusion and so on. But, I've gone through this course many times. I've taught it several times on platform and all over the world. And I'm telling you that what you get from the lectures or, the PowerPoints and so on, it's not sufficient. You've got to do some research. You've got to do a lot of reading. You've got to get this industry and this company sort of a second nature to you. You've got to understand them very well, and you will be able to do very well with the final project and the milestones. Remember, the milestones are graded differently. They have different gradings and different ratings for each milestone and then the final project. So we have different numbers. If the milestone were exactly the same, then you go from milestone, you get all of the numbers there, then you put them together and you get 100% on the final project. And that's not the intent. The intent is to kind of walk you through slowly, milestone by milestone, And then once we give you all of the things towards the end, then we're able to kind of expand those the questions and get you to thinking and using a little bit more of the skills and the knowledge that you have picked up over the course. And that makes a lot of sense. Okay, so I'm going to stop there, take a look at this, and I'm grading your discussion right now, and I'm going to be looking at the milestone, trying to get these things all graded as quickly as possible. All right, and I'm going to send you the PowerPoints for this week. Okay, well, take care, good luck, and we'll be talking over the next week. Bye.